Good morning and welcome to the Xerox Holdings Corporation First Quarter 2021 Earnings Release Conference Call, hosted by John Visentin, Vice Chairman and Chief Executive Officer. He is joined by Xavier Heiss, Chief Financial Officer. During this call, Xerox executives will refer to slides that are available on the web at www.xerox.com/investor. At the request of Xerox Holdings Corporation, today's conference call is being recorded. Other recording and/or rebroadcasting of this call are prohibited without the express permission of Xerox. After the presentation, there will be a question and answer session. To ask your questions at that time, please press star 1 at any time during this call. You can withdraw your question by pressing the pound key. During this conference call, Xerox executives will make comments that contain the forward-looking statements which by their nature address matters that are in the future and are uncertain. Actual future financial results may be materially different than those expressed herein. At this time, I would like to turn the meeting over to Mr. Visentin. Mr. Visentin, you may begin.
Good morning and thank you for joining our Q1 2021 earnings call. I hope everyone is safe and healthy. Our first quarter results were in line with our expectations. Revenue totaled $1.71 billion, down 8.1% year over year, or 10.4% in constant currency. Free cash flow was $100 million, down $50 million from last year. Adjusted earnings per share totaled 22 cents, up 1 cent year over year. And adjusted operating margin was 5.2%, up 50 basis points year over year. In the first quarter, in an environment where many offices remained closed, we grew equipment sales and IT services revenue year over year. I am proud of how our employees have continued to deliver for our customers during the pandemic. With small and medium-sized businesses and enterprise clients planning to return more employees to the office, our differentiated offerings are well positioned to serve their growing needs. The strength of our performance, portfolio, and strategy gives us confidence we will return Xerox to growth in 2021. The team remains laser-focused on our 4 strategic initiatives: optimize operations, drive revenue, re-energize the innovation engine, and focus on cash flow and increasing capital returns. We made progress across each of these initiatives during the quarter. Continuing to optimize operations for simplicity, improve our cost structure, and expand margins must be balanced against investing in growth. Project Own It helps us strike the right balance, as does our focus on cash. Project Own It is on track to deliver $375 million of gross cost savings this year. Part of these savings are funding investments in growth areas and transformational initiatives, such as our effort to reimagine the service experience from supply chain logistics to customer care. Our investments in artificial intelligence, augmented reality, predictive analytics, robotics, and workflow automation are reducing our costs and making it easier to work with Xerox. We have now integrated these technologies to create software solutions that can transform how service teams support customers. We deployed these software solutions within our technical service organization. Our differentiated capabilities paired with our experience have allowed us to commercialize both the software solutions and a technical services offering, creating new revenue streams for Xerox. In fact, we recently signed our first competitive OEM customer for technical service. This OEM will outsource parts of their field service operations to Xerox. Our solution will help them gain efficiencies and provide quality service to their customers. We plan to introduce this offering to other OEMs and companies outside of our industry as well. We have observed a positive correlation between vaccination distribution, people returning to the workplace, and page volumes from our equipment. For the quarter, volumes on the whole remained relatively flat versus Q4. As vaccination distribution progressed, we saw volumes in certain geographies start to increase modestly in late March. For example, in Israel, where more than half the population is vaccinated, the highest vaccination rate in the world, work from home transitioned to more of a hybrid work environment, and page volumes returned to near pre-COVID levels. The return to the office and accelerating vaccine distribution, combined with strong demand for our equipment during the first quarter, are leading indicators that the improvement in our revenue trend will continue throughout the year. Investments in our workplace A3 and A4 and production portfolios have allowed us to grow equipment sales revenue in every category year over year and take share in our territory, according to the most recent IDC data. New capabilities in workflow automation and enhanced security are driving increased interest in our workplace products and earning Xerox industry recognitions. Corsica recently recognized the strength of our hardware and security, as well as our cloud, software, and delivery capabilities, by naming Xerox the leader in its worldwide managed print services market report. Our IT service business grew for the third consecutive quarter. The team is winning increasingly sizable and comprehensive deals to manage the full IT stack for SMB customers. In the quarter, we expanded our IT services portfolio by launching robotic process automation as a service, leveraging our own experience deploying this technology internally across all of Xerox. The pandemic has challenged SMBs to find sustainable cost reductions while maintaining productivity. Our offerings to automate routine tasks such as deal pricing, order processing, payroll, and resource management have already gained traction with customers. In software, the team started to integrate CareAR, an enterprise augmented reality company we acquired in late 2020, both operationally and from a portfolio perspective. CareAR makes any user an expert capable of solving issues remotely through live visual interactions, self-guided instructions, and contextual data for greater insight. This technology provides many benefits, from reducing costs and downtime to improving the customer experience and eliminating many on-site visits. CareAR is at the center of our software solutions, which integrates PARC's artificial intelligence technology, Alto AI, our content management system, DocuShare, and XMPie's personalization software. These solutions focus on three main areas: digital platform as a service, content creation and management, and automated workflows and intelligence, and have several industry-specific applications. Use cases include training retail associates, virtually processing claims, helping with facility-related issues, and troubleshooting data center operations. Within a few months' time, we launched pilots with several global businesses in hospitality, high-tech, and IT services. We also signed up major partners, including ServiceNow, Deloitte, and HCL. These partnerships are already helping us reach new prospective clients and build a strong and growing pipeline. Regarding Xerox Financial Services, we signed our first OEM partner. Our strategy focuses on adding other OEMs and customers outside of our industry while increasing penetration rates of Xerox accounts, all of which should enable us to grow the portfolio. PARC Innovation has continued to make progress across our focus areas, including 3D printing, industrial IoT, and clean tech. In additive manufacturing, our solutions are designed to integrate into manufacturing operations to reduce risk in the supply chain. Global supply chains that rely on just-in-time model are becoming increasingly more vulnerable. The recently launched Xerox LMX 3D liquid metal printer can help alleviate some of that vulnerability. This printer provides advantages over powder-based metal 3D printing, which is predominantly deployed technology today. The LMX printer is safer, more cost-effective, and faster. At the end of last year, we established a product development collaboration with U.S. Naval Postgraduate School. This collaboration will aid NPS in pushing the adoption of 3D printing throughout the U.S. Navy. The military supply chain is among the most complex in the world, and MPS understands firsthand the challenges manufacturers must address. Their feedback is helping us refine the LMX's roadmap, which includes incorporating additional metal alloys, more complex geometries, and larger build volumes of production parts. In IoT, we are preparing to commercialize solutions that monitor the health and critical infrastructure, such as bridges and roads. Aging infrastructure is a global challenge. We recently completed a pilot with Victrac, a state-owned enterprise in Victoria, Australia, to monitor various infrastructure assets for structural degradation and prioritize maintenance. Public-private partnerships will be critical in solving the infrastructure challenges there and throughout the world. Xerox has a long history of inventing technologies that make the world more sustainable, and we are now carrying forward our legacy with our clean technologies. The team continues to make progress on engineering an air conditioning solution that significantly reduces greenhouse gas emissions through greater energy efficiencies. Other research projects include batteries, green hydrogen, and environmental sensing and monitoring. These innovations will open the doors to new partnerships for park innovation and can potentially have major impact on the world. Given the progress we've made, we are accelerating our plans to stand up XFS, Xerox Software, and Park Innovation as separate businesses, which will provide greater focus, visibility, and flexibility for each business. And now we expect to complete this in 2021 and will provide more information on each business, including financial metrics and relevant KPIs, such as loan originations for XFS. Balancing investments in new and existing businesses while generating cash continues to remain a focus for this team. Our free cash flow in the first quarter was in line with our expectations. The first quarter is seasonally our smallest quarter, and the business continued to experience headwinds from the impacts of COVID-19, though we kept investing because we are managing the company to deliver long-term, sustainable growth. We closed the quarter with $2.5 billion of cash, cash equivalents, and restricted cash on hand. In the quarter, we purchased 162 million of shares, demonstrating our confidence in the company's long-term trajectory. We remain committed to our shareholders' return policy, including our current dividend rate, and plan to return at least 50% of annual free cash flow. Before turning it over to Xavier, let me address some of the frequently asked questions we receive. We expect the improvement in our revenue trend to continue. More employees returning to offices, the acceleration of vaccine distribution, and increased demand for our equipment during the first quarter give us confidence that we will meet our full-year guidance. We are managing modest supply constraints. The investments we have made in our portfolio of offerings are starting to pay off. IT services grew organically for the third consecutive quarter. Expanding this portfolio to include robotic process automation as a service will further enhance our momentum. We are seeing increased interest in our differentiated software solutions, which have the potential to transform the service experience across many industries. We will continue to invest in our future while managing our expense profile. We are accelerating our plans to stand up XFS, Xerox Software, and Park Innovation, positioning Xerox to return to growth and unlock value sooner. Now I'd like to hand it over to Xavier to cover our financial results in detail.
Thank you, John, and good morning, everyone. As John mentioned, we are pleased with quarter one performance. For revenue, we delivered a strong improvement compared to the trend over the last 3 quarters. Both equipment and post-sales revenue improved in March, consistent with the progress of vaccinations and the gradual reopening of workplaces. Equipment revenue growth was stronger than higher margin post-sales revenue, driving the 260 basis point gross margin erosion year over year. I will provide more details on revenue in the next slide. Adjusted operating margin of 5.2% in the first quarter increased 50 basis points year over year. The 50 basis point improvement in margins reflects the favorable impact from lower bad debt expense, savings from Project Own It, and discretionary spend action, partially offset by the impact of lower post-sales gross profit. SAG expense of $448 million decreased $93 million year-over-year, reflecting a continuous focus on cost. The improvement includes the impact of an incremental $60 million bad debt reserve taken in the first quarter of 2020, lower selling expense, cost savings associated with Project Own It, and temporary cost reduction measure. RD&A investment were maintained to protect innovation in future revenue streams. Investments focus on existing and new product and solution in the print business, as well as adjacencies on innovation power. Quarter one RD&E as a percent of revenue was 4.3%, 20 basis points lower year-over-year, reflecting continuous optimization of the print portfolio. Other expenses, net of $4 million, was $19 million lower year-over-year, primarily driven by a reduction in non-service retirement-related costs, partially offset by higher net interest expense. First quarter adjusted tax rate was 27.7%, compared to 29.4% last year. The 170 basis point year-over-year decrease results primarily from a change in the geographical mix of earnings. Adjusted EPS of 22 cents compared to 21 cents in the same quarter last year, reflecting a slightly lower adjusted net income impacted by $10 million higher net non-financing interest expense, which was more than offset by a reduced share count. GAAP EPS of 18 cents was 21 cents higher year-over-year due to lower year-over-year restructuring and related costs, non-service retirement-related costs, and transaction and related costs. Turning to revenue, trend improved across all geographies. In EMEA, the rate of revenue decline moderated more significantly than in the U.S., in part due to the earlier onset of COVID-19 in EMEA last year, and partly due to a higher proportion of SMB customers in the region. SMB customers have been returning to workplace more rapidly than large enterprises, who are slower to return to large office buildings. Equipment sales of $381 million increased 17.2% year-over-year, or 14.2% in constant currency. Sales increased across entry, mid-range, and high-end product, and in both North America and in EMEA. We are encouraged by the increased activity indicating customers' confidence in returning to the workplace. Indirect channel sales in EMEA and the U.S. remain strong in entry mono. Channel sales of mid-range product, including low-end color and black and white devices, as well as the recently launched PrimeLink light production devices, grew significantly. Resellers continue to manage inventory below pre-pandemic levels, but are modestly increasing inventory based upon firming demand. In the Americas, sales in North America were in line with expectation. In the U.S., federal government sales remain strong, and education is starting to recover as schools prepare to reopen. Post-sales revenue of $1.3 billion in quarter one declined 13.4% year-over-year, or 15.6% in constant currency. However, sequentially, the rate of decline in post-sales revenue improved by 7.9% in constant currency. Post-sales revenue is largely contractual, and most of our contracts include a minimum fixed charge and a variable charge based upon print volume. Print volumes remain below 2019 levels, e.g. pre-COVID-19, in the quarter, primarily as a result of COVID-19 related business closures. However, we saw a modest sequential increase in page volume as the quarter progressed, consistent with the rollout of vaccination and more employees returning to offices. Post-sales also include unbundled supplies, paper, and other sales, which are largely sold through indirect channels and are more transactional. The rate of decline of unbundled supplies improved sequentially across all geographies, reflecting higher equipment sales on increasing page volume in the quarter. IT services sales for the quarter, which are included in other sales, grew organically in XBS in the US and grew in the UK and Canada as a result of prior year acquisitions. We are pleased with the traction in IT services, and we are continuing to expand the coverage of these offerings to SMB customers. While the environment remains uncertain, we are encouraged by the quarter performance, the strength of the service contract pipeline and installed backlog, which provide confidence that businesses are ready to reopen and resume investing. Turning to cash, we closely manage cash at every level of the organization. Also, COVID-19 headwinds continue to impact quarter one result. We generated $117 million of cash from operation. So continued focus on working capital management resulted in a $43 million source of cash in the quarter, down $48 million year over year, with strong year over year improvement in cash from inventory, partially offset by lower cash from accounts receivable and accounts payable. Cash from accounts receivable was impacted by a lower sequential decrease in revenue as compared to the prior year. For accounts payable, cash was impacted by the timing of payment as well as lower purchase in Q1 2021 due to inventory reduction effort and lower expenses. CapEx was $17 million in the quarter, supporting the strategic growth program and continued investment in IT infrastructure. We continue to expect CapEx of $100 million for the full year. Within financing cash flow, we repaid $94 million of debt from securitizations. This debt amortized monthly, and we expect to refinance it with new securitizations in support of XFS, the global payment solution business. We also repurchased $162 million of shares in the quarter and paid $54 million in dividends. We expect to repurchase shares opportunistically and had $338 million of repurchase authority remaining as of March 31st. Free cash flow for the quarter was $100 million. With a maniacal focus on cash, we remain confident in the guidance of generating at least $500 million of free cash flow in 2021. Regarding profitability, we are relentless in the effort to optimize operations to drive profit on cash. Since its inception in late 2018, we have taken $1.4 billion of gross costs out of operations through the Project Own It cost transformation program. Another $375 million of gross cost savings is targeted in 2021. We generated positive cash flow on adjusted earnings in every quarter impacted by the pandemic due to a flexible cost structure on disciplined expense management. Not only do we expect margin on cash flow to improve in 2021 as the economy recovers, but through continuous focus action, we expect margin to improve beyond this year. Let's focus on XFS now. In January, we discussed plans to stand up 3 businesses, XFS, software, and Park Innovation. Looking at XFS, Xerox has provided leasing options to customers for decades. XFS product enables customers to purchase the newest technology on office equipment while managing their cash flow. XFS growth strategy includes expanding leasing options beyond print to adjacencies like IT services and software. We are also expanding leasing beyond Xerox product and solution through OEM partners such as Lexmark, which we announced will be partnering with Xerox to provide financing for managed print services engagement. We know and understand leasing in this space. Today, XFS manages over 700,000 equipment leases across a diverse portfolio of customers and geographies. We employ a proprietary and disciplined credit approval process that drives low annualized loss rate while allowing for a wide credit window. XFS lease origination increased in the quarter as compared to first quarter 20 due to an increased level of XBS origination in line with the strategy. At the end of March, XFS has $3.4 billion of finance assets consisting of finance receivable on equipment on operating lease. We leverage finance assets at a 7-to-1 debt debt-to-equity ratio today. Therefore, $2.9 billion of total debt support XFS assets. XFS debt includes senior unsecured bond on securitization, and we plan to increase the amount of securitization which provide cost-effective funding. Looking at capital structure, net core cash was $1 billion at the end of the first quarter on $4.4 billion of debt outstanding, the majority of which, $2.9 billion, support XFS. The remaining debt of around $1.5 billion supports the core business. Debt primarily consists of senior unsecured bond on securitization, and there are no bond maturing in 2021. We had $2.5 billion of cash equivalent and restricted cash at the end of the quarter, which, when netted against core debt, result in a net core cash position of $1 billion. The decline in cash from year-end primarily reflects the initiation of opportunistic share repurchase, given the confidence in our strategy. Now, to wrap up, we are pleased with the gradual recovery during the first quarter given the evolution of the pandemic. The pace of global rollout of the vaccinations should result in more employees returning to the workplace in the coming weeks and months. Therefore, we expect a recovery in the business throughout the year, especially in the second half. This, along with first quarter result, provide us confidence in delivering full-year revenue of at least $7.2 billion and generating at least $500 million of free cash flows in 2021. Thank you, and now back to John.
Thank you, Xavier. Now let's open the line for questions.
Thank you. As a reminder, to ask a question, you'll need to press *1 on your telephone. To withdraw your question, press the # key. Our first question comes from Ananda Baruah with Loop Capital. Your line is open.
Hi, good morning, guys, and congrats on solid progress. Hey, a few if I could. You guys mentioned that small medium business is opening up faster than large enterprise. Makes sense. I know the small medium business expansion in general is an important part of the structural strategy, and so I was wondering if there's anything that you're doing there to accelerate the small medium business expansion, given that that's the part of the economy that you see opening up more quickly. And then I have 2 follow-ups. Thanks, quickly.
Yeah, Ananda, with small and medium business, we're seeing progress in different areas. Our IT services business, so we're helping them not only open up again, but we're helping them focus on their cost reductions and managing their businesses. So our IT services offerings, we've seen some good progression in SMB. We just announced 6 bot offerings that inside of the first quarter we already had clients that are taking it over. So it's a full solution for SMB, and that's how we've been approaching it.
And John, do you have I guess like sort of if you dial it back to kind of 5-6 quarters ago, do you believe the revenue opportunity there over time because of the solution, some of the new solutions that have arisen as a result of the last 12 months or so? Do you think that levels up the revenue opportunity there?
Yeah, I think what gives us confidence is if you look back, we announced the IT services. We continue to announce offerings in SMB. We've also expanded IT services in the UK. And what gives us confidence is seeing not only our growth in these services, but also our growth in the ESR and in the hardware that we saw in the first quarter.
That's awesome. And just real quick on large enterprise, or just enterprise in general, as distinct from SMB. Do you have any context you can share from your conversations with enterprise customers, sort of the timing of after they open up, when they may begin, like how long before they begin to put print projects on?
What we've noticed is as clients open, as clients open, our clicks, as we call them, continue to increase. But I think as we're looking at the correlation between the vaccination rates, the page volumes in our geographies, we're seeing our post sales grow as well. And more and more CEOs are talking not if they're going to reopen, but when and at what speed.
Okay, that's helpful. And then one quick one for Xavier. Xavier, any reason that long-term free cash flow should not return to the same percentage of net income as historically it's been?
So as John mentioned, as you know, our business is based on two revenue streams, the equipment stream and the post-sale stream. The post-sale stream is gradually recovering, and this is the stream that has the higher margin here. So when over time this mix will improve, and we see that, we have seen some positive signs on page volume coming back, and also activities that we are doing for our customers which are not directly related to print, but related to transactional volume. As these volumes are increasing, we see clearly the opportunity for income growing, and then free cash flow growing as well.
Okay, that's helpful, guys. Thanks a lot. Appreciate it.
Thank you, Ananda.
Thank you. Our next question comes from Matt Cabral with Credit Suisse. Your line is open.
Yes, thank you. Good bounce back on the equipment side this quarter. I guess as we dig underneath there, I'm curious how much you characterize as some sort of backlog or pent-up demand as employees are returning to the office versus more just the underlying demand picture that you're seeing, and just going forward, how we should think about the cadence of equipment revenue for the balance of the year.
So Matt, what we see that first, our equipment revenue grew in every segment. So as you have seen it on the A4 entry segment, it was a significant growth, but also A3 on production grew during the quarter. So we see a confidence from customer bringing back in line with vaccination employees in the office on acquiring or renewing some equipment. So which will drive at the end of the day the page volume on the annuity stream that is one of the mainstream of our revenue here. So it's not only like a backlog. We ended the quarter with a strong backlog, but it's not only like a backlog recovery. It's literally related to confidence that the business has currently in order to bring back employees in the office.
Thanks for that. And then on XFS, on the FinCo, I'm wondering if you could expand a little more on the opportunity you see to securitize as a cheaper way to get access to financing versus, historically you've used the wider Xerox balance sheet as you've tried to get capital. And I guess as that securitization picks up going forward, I'm curious what that means in terms of incremental balance sheet capacity for more of the core business, and assuming that does free up some capacity, just what you look to do with it going forward.
Yeah, so first one, securitization, as you mentioned, it gives us, two benefits. The first benefit is it moderate or decrease, the cost of funds that we have to support this business. And this is part of the strategy that we initiated by standing up XFS. So as you know, XFS is a significant, part of, the enablement that we bring in this business. And I'm sure you saw it as well. We are now expanding the XFS portfolio and offerings, not only to Xerox products, but to other third-party OEM and other vendors here. So securitization helps us from a fund point of view. Securitization helps us also on our ability, to expand this activity and to manage properly our free cash flow on this one. We will certainly be more, I would say, industrial, more structured in the way we approach the securitization quarter by quarter. And we have started last year having, two main tranches of securitization, and we'll carry on this year on securitization as well.
Thank you.
Thank you. Our next question comes from Katy Huberty with Morgan Stanley. Your line is open.
Thank you. Good morning. I'm a little surprised to see the Americas revenue so weak, just given the success of the vaccine rollout here, and also given all the surveys are showing that U.S. tech spending is rebounding much faster than Europe. I know you made a few comments about SMB exposure in Europe, but can you talk a little bit more about why that is? Are European customers less likely to be on contract, so that's just a more transactional business? And then just as a second part to that, what do you think the contribution to equipment sales was in the quarter from inventory rebuild at some of those channel partners?
Okay. So, Katie, I will take care, of Americas first. The America revenue is in line with our expectation. As you mentioned vaccination progress here. However, large enterprise, are starting, slowly to bring people on SMB. We saw growth specifically on our SMB businesses here. I say growth. We saw improvement, in the page volume, coming back here. Europe, as you know, it has been hit last year, earlier as well. So when you look at the year-over-year compare, you had more weeks of COVID impact in Europe compared to this year. You have seen as well that in both geography, EMEA and in Europe, after quarter four where we saw some activity coming back on page volume. December we have seen some lockdown, and then January, February in certain geography in EMEA, Canada is an example, certain states in the US, certain geography were slower. The good sign and indicator that we are seeing currently is in March. In both geographies, both territories, we saw page volume improving and transaction improving here, which give us confidence as well, added, to the fact that ESR revenue was strong, give us confidence in the revenue trajectory. Commenting now on the, equipment sales on the building inventory there is no direct correlation. What we saw is that there is a progressive, rebound or step-by-step improvement in inventory level, but these levels are not the levels that we were seeing before.
Okay. And as you think longer term about a more hybrid workforce, would you expect page volumes and post-sales revenue to return to pre-COVID levels, or do you think we should contemplate post-sales revenue that's maybe a little bit below where we were pre-COVID once the end market stabilize?
We have, Katie, as John mentioned it, we have one data point, on a country which has a high vaccination rate, which is Israel, and we are monitoring this country specifically here. And in Israel, with more than 60% of the population being vaccinated, we observe page volume coming back to very close or slightly lower than the pre-COVID-19 levels. What we observe as well is that even when you are in a hybrid environment, and we see hybrid having different definition company by company. When we are in hybrid model, when employees return to the office, their page volume is also a page volume that recover some of the pages they are not printing at home as well. So far, a little bit early to confirm all these cases here, but as I mentioned it, in March, we show page volume increasing. We clearly monitor and track the correlation between vaccination, office presence, and page volume, and these three indicators correlate very strongly.
Great. And then just lastly, the $60 million of bad debt expense, is that largely coming from your small, medium business customers? Is that from channel partners? And was there any concentration by region?
So the $60 million, Katie, was a provision we took last year across, our entire XFS portfolio. And as I commented here, XFS has a very strict rules and strict ways of looking at the credit risk of partners. Our portfolio is diversified by geography, but also by customer type. And we have, like a AAA, AA, and high-level type of rated company here. The provision was put there in order to assess, what could be the impact. We are running every quarter what we call stress test on our portfolio. And currently, we are confident that this provision is at the correct level. Our lease contract are in average a 4 years period. So it's too early at this stage, to declare that the provision is, I would say, overvalued. Currently, what we are just assessing is that this provision is sufficient to cover the risk we could have in the portfolio.
Okay, understood. Thank you so much.
Thank you, Katie.
Thank you. Again, if you would like to ask a question, press the star, then the 1 key on your touchtone telephone. Again, that's star 1 to ask a question. Our next question comes from Shannon Cross with Cross Research. Your line is open.
Thank you very much. I have a few questions as well. John, just from a big picture standpoint, and some of your peers in Japan have started talking about this more. When we go out, say, 3 or 4 years, how do you envision Xerox? And what I'm trying to figure out is, what kind of revenue percentages would be coming from printing versus some of your more focus areas, software park, XFS, services. And then how do you sort of, again, 50,000 foot level, see the margins shifting? Because obviously print is a very high margin business, but not growing. And some of the others, have more opportunities. So I'm just trying to get an idea of maybe from a high level how you see the business shifting.
Yeah, Shannon, what excites us is our four-pronged strategy. So one of them being monetizing innovation and driving revenue. And in there, we've seen progress in our software business. We've seen progress in XFS. We've seen progress also in all our innovation. And we did just say that we're going to be standing up these businesses before the end of the year. We're doing that for a few reasons. One, it's focus, it's flexibility, but also it's to provide transparency to our investors. So you can expect us to have an analyst day in the second half of the year where we will be going through this and explaining to our investors why Xerox is a good investment for now and for the future.
Okay, so we can't get it quite yet. I guess then in terms of cash usage, you used $216 million during the quarter. You said you'll return at least 50% to shareholders and targeting $500 million at a minimum for cash. So clearly there's a little more room, but if I add in what you've done so far plus keeping the dividend, you're going to be somewhere around 75% of cash usage already, or free cash generation already. So how should we think about share repurchase as you go forward? And obviously I'm assuming the dividend is solid. Thank you.
Hey, Shannon, Xavier here. So, as we mentioned we will always look at the share repurchase as in an opportunistic way here. As you mentioned it, we repurchased $462 million of shares during the quarter. We mentioned in prior call there that we have an authority of $500 million. So there is still more than $300 million which is currently left here. And we will do that opportunistically for the year.
Okay, and then my final question is just, and to some extent going back to Katie's, as you talk to customers these days, and now that we're a year plus through the pandemic, and people are kind of reevaluating how their offices are going to look and what they're going to do, what kind of changes are you hearing in terms of structure? Are people looking at more distributed printing? I would assume so, given the growth in the low end. But and then how are they thinking about what contract levels they're willing to sort of commit to, given there's still uncertainty in terms of who's going to be in the office and how many people are going to go hybrid? Thank you.
Yeah, Shannon, if we look at just surveys that were done with CEOs last summer, you had 69% on a certain CEO on a certain survey that where CEOs said they're going to downsize their real estate footprint. This was just reconducted recently, and it's down to 17%. I think the focus is going to be at what rate and pace will the employees be going back to the office. And it's a direct correlation to vaccination and to safety. The other thing that we're starting to see a little trend on is that they go back to the office, even in a hybrid environment, the print volumes go up. For cost reasons, for security reasons, it's a lot less expensive to print in an office than it is to print at home for security reasons. So we're seeing that trend, and that's what gives us confidence with our guidance for this year to get back to revenue growth.
What's your plan for Xerox? When are you going back to the office?
April 19th.
Thank you.
And Shannon, just back to your question on the customer, what customers are buying currently? They buy the multifunction, as you know, it is much more than a printer. The multifunction is the core of workflow that customers are looking at. And there is something that we learned during COVID-19. It's like this concept of digital transformation or enabling, a workflow which is much more efficient for employees, required a device which is able to support this process transformation. On multifunction are chosen currently by customer as a prime device in order to drive this.
Thank you.
Thank you. Our next question comes from Paul Coster with J.P. Morgan. Your line is open.
Chung on for Coster. Thanks for taking our question. So just on the OpEx side, we saw big decline on cost execution, lower discretionary spend in 20, and one key run rate is pretty in line as well. Just want to get a sense for what you think about OpEx in the back half as some of those costs come back, and then secondly, where are you targeting those investments in marketing spend when it does come back? Thank you.
Okay, so OpEx, you need to look at it by looking at last year versus this year. We have had last year, some tailwind. We declare, the government subsidies we benefit from. We also look at all cost opportunity we had while the pandemic was at the highest point, specifically in quarter 2, quarter 3. This year we resume, some of either the benefit or the provision we have for compensation, and also the I would say tailwind related to government subsidies are less, as it here. However, what we see is, from cost point of view, we have kept the mantra, the focus that we have with Project Own It. We declare that for this year we will run another 375 million of growth savings driven by this program, and it is again, across all the different areas of the Xerox cost base here. We have a specific focus on the innovation. On when I say innovation, automation, on improving our current processes, making customer relationship and customer transaction easier and simpler by bringing simplification here. So you should look at this as being like a maniacal focus that we have on cost. I mentioned it in former calls. We have delivered positive EPS and positive free cash flow every quarter despite COVID-19, and this is key drive that you have currently.
Thanks. This is very helpful.
Thank you. Our next question comes from Jim Suva with Citigroup. Your line is open.
Thank you. I have a question probably for each of you, and I'll ask them immediately at this time so you can decide how to answer them in any order you want. But John or Xavier, can you talk about for the services that are being offered? There's so many services out there in the world. Where's the success that Xerox is having on the type of services? Because I find it very intriguing and quite encouraging. It seems like it's on the small and mid-size, but is it, help desk? Is it robots or bot programming? Or, what are some examples so we can kind of grasp and visualize it? And then my second question is has there been an impact from the semiconductor shortages? Globally, some sectors like automobiles or PCs have seen a very severe shortage of semiconductor chips. So I'm just kind of wondering if that has replicated or found its way into the sectors you deal with, or maybe it hasn't. Thank you.
Yeah, hi Jim. Look, our IT services is focused primarily on SMB, and basically our mission is to provide end-to-end professional IT solutions to them. We've introduced new offerings such as RPA as a service, but at the end of the day, we're not a VAR. Our design is to manage the IT stack of an SMB, the goal being virtual CIOs for them. And our customers are largely served by our XBS organization in the U.S. They're served by our channels in Europe, and these are direct sales organizations that have skills at local touch points so that we could expand on our offerings, cross-sell, and into existing accounts and new customers. And we've seen a lot of good traction, even with our RPA products that we've been focused on. We've seen traction on that whole area of how do we help them, be more efficient as they're coming back to the office. And we've been very pleased with our results and all of that.
Semiconductor?
Okay.
I can build maybe John.
Semiconductor.
Yeah. Jim, also two other offerings where we see traction currently. Everything around, I call that digital transformation, but behind content on capture, on customer engagement, services that we have as part of our global business services offerings here, is currently having a lot of focus on customers are interested in transforming, digitalizing, or making their process leaner, by combining both the print and the digital part of this. Another, I would say, highlight I would like to flag is Care AR. John alluded to it here. We made the acquisition of this company in December 2020, and currently with augmented reality supporting field service management and customer service management, we see initial traction, being confirmed or being developed by signings that we have with customers being interested in this technology on how we transform the way field service management and customer service management is being delivered. So, yeah. Your question regarding semiconductor shortage here is we see, like you observe it here, some shortages on certain components, also on certain raw material. Does not believe at this stage it is impacting us directly. We are monitoring it, and we are looking, at the potential backlog that we could have related to it. But it's not, at this stage, a high level or high area of concern for us.
Great. And then a quick follow-up on the bad debt reserve. It sounds like it was a release in that it was a positive that you reserved a year ago a higher amount for potential uncertainty of customers if they'd be able to pay given the pandemic uncertainties, and it turns out that you're collecting better than previously thought. Am I correct on that? And is that kind of a annual assessment or quarterly assessment where there could be some more positive releases?
So, Jim, it was not a release. So it's a difference. It's a year-over-year compare. Last year, we booked around $60 million of provision for potential bad debt release across our leasing portfolio. And as you know, this portfolio has an average maturity date of around 4 years. So this is regarding the current lease and the future event that could happen to these leases here. We did not release any provision. We kept this provision because it's very early in the cycle for us to assess if and when we should release any of these provisions at this stage. Currently,
Great.
Our assessment is that the provision level that we have is sufficient to cover the potential risk.
Thank you so much for the details and clarifications. It's greatly appreciated.
Thank you, Jim.
Thank you. And ladies and gentlemen, that does conclude our Q&A session for today. I would now like to turn the call over to John Visentin for closing remarks.
Thank you for your questions. This past Sunday, we celebrated our 115-year anniversary. We believe today our future is filled with exciting possibilities that we are working to make realities. Xerox has repeatedly redefined how the world works, and we are well on our way to doing it yet again. Be safe and be well.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect. Everyone, have a great day.